Here's the trade of the month for August 2019. So let's get started. Today we're going to look at Patterson-UTI Energy Inc. versus Vermilion Energy. One's on NASDAQ, one's on NYSE. And this trade is part of the new top 30 that were introduced at the end of July, beginning of August. It has done $1,296 in 16 market days, a 33% return on margin, assuming a $10,000 leg size. So that's a very nice trade. We like to see ones like that. And let's take a closer look, see how it looked at its entry. So first off, trading signals. The call was on the 30th of July, and it was to short Patterson and go long Vermilion. And importantly, the entry was 2.91 standard deviations. So we were using a 2 and a 0, so this had a big move. And the question was, what caused that big move? And would you have taken the trade based on the fundamentals and technicals at the time? And so let's quickly seek to answer those questions. First off, what are we dealing with here? Patterson-UTI Energy. It's got a market cap of about 1.8 billion and a high beta. These are in the oil services sector. So Patterson-UTI is an oil and gas drilling company, mainly natural gas. 8,000 employees based out of Houston, Texas. And we've paired that with a similar but not same industry sector company called Vermilion Energy, which is based out of Calgary. And they are an E&P producer. They have acreage all throughout North America and some international as well, Paris, Europe, and other places. And they've got about 700 people, obviously a lot less in E&P than you do in a services company. They also have a market cap around 2.3 billion and a beta of 1.6. So on that basis, they're reasonably similar. They're both traded in the U.S. as well. So that's why we selected them. I won't go into more detail on their businesses, other than to say it's a bit of an unusual pair for us because they are in different industry sectors, even though they are in the same segment, which is energy, but they're very closely aligned. And why did we choose them despite that fact? Well, all you need to do is look at the back test of this pair, and you see that it's quite interesting. So over the last 3 years, 12 trades, 67% correlated. Core integration has just dropped slightly over the last month or so, but it was co-integrated when we selected it. It still is basically, rounding errors in data. Compound annual growth rate 23% on a max draw of 17.7. High profit factor. Made a net profit of 8,741, or about 730 a trade with 75% winners, and the average days in trade about 30 days in trade. You can see the equity curve here over the last 3 years. Bottom left to top right, nicely sloping, not too many drawdowns, not too big a commission take by the broker. The ratio is a bit trendy in the middle of this period, but then over the last 18 months has really flattened out, which makes it an attractive pair and also has increased the profitability here in the last year or so. So that's why we selected it. We like the looks of that. Before we jump onto the pair charts, let's take a look at how this looks graphically. This is the comparative performance of the two stocks over the last year. And what you can see is the very, very close correlation between the two and also the co-integration. So when the relative performance diverged, it reconverged. Here again, a divergence, reconverged. Here again, a divergence, reconverged. So it's a pretty tight pair, but it looks very good on that basis for trading. So we would also take a quick look at the stock chart versus the news. And I'm going to do that because we want to see what generated this signal. It was obviously a pretty big move to go to 2.9 standard deviations. And just quickly pull up the news releases. So on Patterson, the closest news release was July 25th. And that's 5 days before the signal was called. And they had the results for the 3 and 6 months ended. And what you can see here, I won't go through all the detail, but suffice it to say that the results were big share buyback increase announced. So that's, stock positive if you believe in those types of things, if they're doing it at above book value. They may actually be destroying shareholder value, but that's for you to decide. The results, operating results, were pretty much in line. Nothing too exciting. So the only big thing that was of news here was the fact that they are increasing their repurchase authorization to 250 million, which is pretty substantial, about 5% of the shares. So what happened here was on the date of that release, it had dropped, then it flattened, then it popped a few days later, right around the time of when the next press release happened that caused the divergence in the signal. So there was some increased volatility here, which was interesting. And net, the share price didn't change that much at the end of that volatility. But that is probably part of what caused the signal. Let's go to Vermilion. This was the press release that caused. Sorry, I'm on the dividends here. Let's just go to the news. That caused the signal to be generated, and the press release was just earnings announcement. Okay, so do we trade earnings announcement? Well, we read them and we figure out what's going on. So the 29th of July was the earnings announcement, and that caused, again, I won't go into detail, you should read it carefully, form your own opinion about whether it's fundamental value shifting, what they've released, and it's an E&P company, so it's fairly complex to go through that unless you are familiar with E&P, but I'll just say that let's look at what the market did on the basis of that. So for the 3 days before the earnings release, you saw these three very negative bars, and the stock cratered, essentially, before the release. After the release, for 2 days, it was up a bit, and then it resumed its downtrend. So something in that release caused people who were heavily betting against the stock to take profits, and then again they felt like they could continue to sell. So it was this blip up. Actually it would have been this extremely long bar down, which caused the signal, and we can see that the signal was to go long VET at this point, and to go short Patterson, which at the same time had rallied very strongly that day. So those two movements are what caused the signal. And again, I'm not going to go deeply into the fundamentals. You have to do that yourself and decide whether there's a medium-term fundamental value shift as a result of those earnings releases. Let's assume there was not. What we would do before we hit the pair charts is just quickly check. Well, we know the earnings date, so we're clear for trading on earnings because both of them just announced earnings before the signal. You have to look at the dividend dates as well. You had until first week of September for ex-dividend on Patterson, and the end of August for ex-dividend on Vermilion. So you had 30 days, which is exactly equal to the average days in trade based on the back test. So you'd have to ask yourself, is that enough, and do you care? By the way, this dividend amount is incorrect. That's the annual dividend. The yield should be around 3.5, and this one's at 2. So again, the dividend differential on a percentage basis not hugely different. So you probably might be able to safely ignore that, seeing as that if there's no surprises in dividends. So you make your choice whether that's clear. That is probably clear enough if you really like other aspects of it. So let's go to the pair charts. Here was a signal called short Patterson 1156, go long Vermilion at 1737, and you can see here it took it all the way up to essentially a line of resistance on the plus minus chart. So that's very good and not negative in the sense that it didn't break out past that. It just went to the resistance level. If you look at the percent for mean, you get a similar situation here. This is over the last year. Here's the entry. So up into a sort of resistance level, but not a breakout. So again, quite interesting because we're well extended from the mean, but not breaking out. And then you can see the ratio chart here. It's been a very ranging ratio, back and forth over the moving average, lots of zero crossings, and well extended here in a very short period of time. Let's look at the RSI. It's also at an extreme 75. You can try and see if you can find divergences here, but with such a ranging ratio, it's pretty hard to read into them. If you were looking this as, oh, it's gone way up, what's happening here, you could say that if that's a high and that's a high, then this is obviously sloping down, so it might be a divergence, but I would caution that. You could say maybe if this is an uptrend, this is the high and this is the next high, and again there's a divergence there, but you know, this is a lower low, so it's not really trending at all. So you don't really have the gift of the RSI divergences to tell you whether or not it's a good trade to get into. You do have your percentage for mean, you have your plus minus. So, and you do have the fact that you're an extreme. So it's a very fast move. So you would ask yourself, do you want to take it? You'd have to make your own determination, but because it's such a ranging ratio and it's well extended away from that, prima facie, that looks like it might be something that's interesting to trade. And before you do, you would go to your watch list or to your other charts, just check the volatility on this pair, 2.64. That's higher than a normal volatility. You might position this size a bit below 10,000 a leg. Again, up to you, but that's reasonably high. And what happens if you did take the trade? Well, if you did take the trade, this is the exit we were talking about. We did very well on it, which was in 16 days. The trade delivered $1,295.56 net on $10,000 a leg. And that is the trade of the month.